أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم الحمد لله الصلاة والسلام على رسول الله السلام عليكم ورحمة الله وبركاته. Welcome back. Although we only have two of you here, but I'm going to start and the others can listen to the recorded lecture because it's very important that we cover this material and we cover it well. So pay attention to what we're going to discuss. We only have 4 weeks left and 3 chapters, but they're very important. And this chapter particularly is going to help you in doing the simulations. If you can understand this material well, then you can get full marks in the simulation if you pay attention and you understand, inshallah. We are going to do the audit of cash and cash equivalents, and we're going to discuss the following. We're going to define what is cash and cash equivalents, and we're going to discuss the inflow and outflow of cash. Where does cash come from and where does cash go to? The types of bank accounts. We're going to discuss the test of controls, what is done to do the test of controls for cash, and then what we do in substantive analytical procedures for cash, and then what we do in the substantive procedures. What is cash? Everybody knows what cash is. You know, you have some with you right now. For the business, for your client, cash is money that they have in the bank. So either they have money in the current account, which is where you can take money out and put money in without any limit, anytime, as many times as you like. The savings account, however, is has some restrictions, so you might have to maintain a balance, a minimum balance in the savings account, and most banks, well, all banks actually pay interest if you put money in the savings account. And the second type of deposit into the bank account is called the certificates of deposit, where you put a certain amount of money in the bank and you cannot take it out for a particular period of time. So let's say you have a 6-month certificate of deposit. The bank will invest that money and the bank will give you profit from that investment. Now, if this investment is specified, if they say that, you know, we'll give you 3%, 4%, 5%, that is, of course, is interest, riba, which is not allowed in Islam. But if they give you no guarantee that, you know, there may be a profit, there may not be a profit. If there is a profit, we don't know what the percentage is, and you put the money, you invest the money with them, then if they invested in a halal company, etc., then they will share that with you. But this money that you give them, certificate of deposit, amount of money, they will not give that to you, give that back to you for that period of time. So 6 months, 4 months, 10 months, whatever it is, the company will have to keep the money with the bank. Okay, so but all of this is considered for financial statement purposes. All of this on the financial statement on the balance sheet is considered as cash. The second is cash equivalent, which is short-term investments, short-term liquid investments. If you invested money in something that you can convert very quickly into cash. So let's say you have invested money in a particular business, a small business, or maybe you purchased a land that can be sold very quickly, right? And it does not take a long process. There is a big market for it. So liquid investment, it can quickly be converted into cash. Then this is called a short-term liquid investment. And money market funds are stock investments, stocks and bonds maybe, and this is usually managed by a fund manager, and this also can be sold quickly because there is a ready market for it. And this is cash equivalent. Cash equivalents are those items that can be converted into cash without losing much value and time. Is that clear? Now we have cash inflow and outflow. The money that comes in to your client's business, the most regular and most frequent and most comes from revenue, which is the sale to the customers. So cash inflow is, most of it is between your client and the customer. For outflow, the most regular and the most frequent and most amount wise is the first three: purchases of inventory and assets, payments for goods and services, and payroll, paying your employees. So money goes out when you buy inventory and asset, money goes out when you pay for goods and services such as office supplies, cleaning supplies, security services, cleaning services, all of these, and then payroll is your is the employee payment. In addition to that, money comes in from the sales of property, plant, and equipment. The sale of property, plant, and equipment is like selling one of your assets, like a land or a factory or a machine. This is not something that you sell regularly to conduct your business. This is one of your assets or items that you use, right? So if you sell that, you will also get cash inflow. Also by selling stocks, right? So common stocks, you get money coming in. But again, these things are not regular. They don't happen on a regular basis. If you borrow money, if your client borrows money, money comes in. But again, this is not something that happens regularly. Outflow, there is one that we did not address, which is the payment of debts. So borrowing money has cash inflow, paying the loan back is cash outflow. So these are the sources of cash coming in and out. The most frequent and the ones that we're going to deal with is the money coming in from the customer. So when we say inflow, it is between the customer and the client. When we are talking about outflow, it is between the client and when you're talking about outflow, it's between the client and whom? Cash outflow, most of it is between your client and whom? Customer is cash coming in. Suppliers, very good. Don't confuse this. Make sure you understand cash coming in. Who gives your client cash? When they sell something, where does the cash come from? Customers. When they buy something, who do they pay the cash to? The supplier. Clear? Have this very, very clear in your head. Cash received from the customer, cash disbursed or cash paid to the supplier. Clear? Now let's jump right into it. I need 150% of your attention. Okay? There are three different types of cash accounts, bank accounts. Number one is general cash account. A general cash account is an account where any and all deposits and withdrawals can be made. So there is no restriction. You can put any amount of money or take any amount of money and pay whoever you like. This is a general account. The client does everything from that account. This is called the general account. The second type is called an impressed cash account, which is for one particular or two particular purposes. This has a purpose and nothing else happens in that bank account. So the client may open an account and say, this is only for payroll. The only thing we're going to do from this account is pay our employees and nothing else. Okay? This is called an impressed cash account. The client could have a cash account just reserved for buying assets. Nothing else will happen unless they buy an asset. You follow? So this is called what? Impressed cash account with a purpose. The third is branch accounts, which are dedicated for a particular branch and no other branches deposit or withdraw money from that account. So let's say you have a company and it has 5 shops. 4 of them are in Doha and you have a bank account in QNB. All of these 4 branches conduct business there. But you have one shop that is in Al Khor and you have one special account that you opened in Al Khor for that branch only. This is called a branch account. Is that clear? Simple? Okay. Now, the test of controls. We have three different types of test of controls listed here. The first is controls over cash received. Now, who does the cash come from? Most of the cash that is received comes from whom? Customers. So you have to sell to get this. This is covered when you do the test of controls in the revenue process. Remember revenue process chapter 10? Remember revenue process chapter 10? The segregation of duties and the different steps in the test of controls in the revenue process takes care of this. Okay? The second set of controls is on cash disbursements. When the cash is disbursed or paid, remember, you need to remember this terminology. Disbursements means payments. Most of the cash is paid to whom? Regularly, frequently. Who does the customer, your client, who does the client pay the cash to on a regular basis? Suppliers. Employees, of course, employees also, but the most frequently, the employees are paid once a month, right? But you have many suppliers that are paid perhaps multiple times during the month, right? So when we do the test of controls in the, let me see if there is someone who can answer this question. In which process is this control taken care of? In which chapter did we study the controls over cash disbursement for payments made to the supplier? Expenditure cycle. What do we call this? Which chapter was that in our auditing class? Chapter 11. We call this in this course, we call that chapter. What is the title of that chapter? The expenditure cycle. We call that same thing, expenditure cycle in AIS. But what do we call that in the auditing class? What is the title of the chapter? You're opening your slides to see purchasing process. It is purchasing process. Okay. Purchasing process, the same thing, expenditure cycle, purchasing process, they're one and the same. So we check the cash disbursements, controls over the cash disbursements in that chapter. The third test of control is completion of bank reconciliation, and we are going to discuss this a little bit more in this chapter. The client's process of doing the bank reconciliation and our process as auditors to check how well they do, how often they do, whether they do a good job of the bank reconciliation or not. Okay? The next thing after the controls is the substantive analytical procedure. And again, much of the substantive analytical procedures that we have done in the revenue process and the purchasing process also covers this. But we do two things here. Number one, comparing prior year's cash balance with this year's cash balance. Now remember, if we have $1 million in the bank at the end of this year and we had $500,000 last year, it does not necessarily tell you a whole lot, because maybe they had more sales, maybe they did not buy any large assets this year. So you have to do further investigation. Just because the balances are very, very different, it does not, for the cash, it does not tell you a whole lot. For the accounts receivable, it might tell you, but for cash, you can have more cash just by borrowing money from the bank, right? So you have to see further to investigate further and find out why there is a difference. But you still compare the cash of this year with last year. The second thing you do is look at the budgeted cash with the actual cash, both in and out. The client has a budget of cash, and you remember this from your managerial and your cost accounting class, that money coming in and out is budgeted before it's actually spent. And if you compare the actual with the budget, and if it is very close, that means things are fine. Okay? Are you following? So not a whole lot done in the substantive analytical procedure. This is, of course, offset by doing extensive tests of controls, which we did in the purchasing and the revenue process, and then details of cash receipts and disbursements. So now we are going to do this, the details of cash receipts and disbursements. We are going to do this. This is very important. This is heart of the matter, because no matter how good you do your business, no matter how much you sell, no matter how good your suppliers are, if you are not able to handle the money that you're getting and keeping it in order, then what is the purpose? What is the point of doing all this show if your cash is out of control, right? At the end, they say cash is, what do they say? Do you know this saying? Cash is, can you fill in this blank? Anybody know? Cash is what? Any one of you know? Any one of you heard this before? Remember this. Cash is king. Okay? Cash is king. If cash in your pocket, you have many friends and many things you can do. Don't have cash in your pocket? Not much you can do. Okay. And then we will do also extensive test of bank reconciliations. Okay? Are you ready? Are you ready? Okay. I kind of feel sad that only 5 students are here because it's such an important discussion. Okay. So we jump into the substantive procedures. Occurrence is the guarantee that everything that is recorded, who can tell me? Everything that is recorded? Come on, guys. Has happened. Very good. Everything that has been recorded has happened, has occurred. Very good. Now, we are going to take a sample of entries in the cash receipts journal. Cash receipts journal. This is what a cash receipts journal looks like. Every single amount received is recorded. Okay? So every single amount received from the customers or wherever the money came from, it's recorded separately, right? It will say the detail, the date, why, from where it came, how much, right? If there was a discount, if there was an accounts receivable that was related to that, right? So everything that is related to the money coming in is recorded in the cash receipts journal. So this is where the amount is recorded. The question is, this amount is recorded here, The question is, did it happen? Did the sale happen? Did it take place? So we're going to test that. Are you with me? So we take a sample of entries, we take an entry, and we go to something called a remittance advice. What is a remittance advice? A remittance advice is notification of payment. So you see, it says this payment will be in your bank account on May 1st. This is something that the client has received. This is called notification of payment. So if you have a remittance advice that matches with the item in the cash receipts journal, that means that is one proof that the sale actually happened. Are you following? Are you following? The second thing we have here is daily deposit slip. Okay, so Muhammad, this money is recorded here as received. If you go to a remittance advice which shows the notification of that payment, notification of that receipt, then this gives you confirmation that this amount recorded here was actually received. Okay, and these amounts obviously don't match, but you will find for every remittance advice there will be an entry in the sales journal, cash receipts journal, I'm sorry, and in the cash receipts journal, every item you take, you will see a remittance advice. Is that clear? The second thing is deposit slip, daily deposit slip. What is a daily deposit slip? This is what it looks like. A daily deposit slip, the client prepares a daily deposit slip where it lists the amount that they're going to deposit into the bank, and then if they receive checks from the customers, they will list them and they will make a total amount. They will put a total at the bottom and the client will sign here, right? They will sign here, and this money will be deposited into the client's bank account. With this deposit slip, there is a copy of the deposit slip that your client will keep. When you go to audit the client, you will see that deposit slip, and when you see the amount in the cash disbursement journal, and if you find that amount also in the deposit slip, that means that amount was deposited into the bank account. That means when they say we received this money, it actually happened. Is that clear? Okay. Another place you will see this is the bank statement. So if you come to the bank statement that your client received from the bank, you will see deposits listed in the bank's statement. And you will compare that with the cash receipts journal, and you will see that yes, this amount was actually recorded by the bank as well. So you have multiple proofs, okay, of cash receipts. Did it happen? Yes, because you have a remittance advice, you have a deposit slip, and you have a bank statement. So Sharat says, why do we need to check deposit slip if we can directly check bank statement alone? You see this, the bank statement will show the total amount of deposit, right, made on a particular day. The deposit slip shows individual amounts, individual checks that you can compare with cash disbursement, cash receipts journal. So let's say all of this happened in the same day. The bank statement will only show this amount. The deposit slip will show the details, okay? Now, sometimes not all of these documents are available for every single transaction. So you have multiple places that you can check. Okay? You don't necessarily have to find the item in every single place. Do you follow? If the customer paid cash, there will be no remittance advice. If the customer paid cash directly into your business location, there is going to be no remittance advice. You follow? So you have multiple ways of checking this. If the customer transferred the money automatically or paid an electronic payment, only then you will have the remittance advice. So you don't have all of these documents for all of the transactions. So you have to check whichever you have. Is that clear? Plus, remember, the deposit slip is usually handwritten, and don't get me started on reading the handwritten documents from your client. You don't know whether it's a 3 or a 5 or a 7 when the client writes by hand. Okay? So you need multiple documents to ensure that it's written, it's recorded properly. Is that clear? Then we have the cash disbursement. Now here we have something called a cash disbursement journal. Just like the cash receipts journal, we have a cash disbursement journal. Any amount paid from your client's business to anyone is recorded here. Every single amount individually, right? Date, if it was paid with a check, the check number, who it was paid to, what it was paid for, and how much. So it was paid to Kit Corporation, and it's for store supplies, and it's for $496. So all of this is recorded, right? Cash, inventory, whatever the purpose is, it's recorded here. This is the cash disbursement journal. Now you want to see items that are recorded here actually happened. So they were actually paid. That's what you're concerned about. So you take a sample from here and you compare that with first item, cancel checks. So if it was paid with a check, you will find a canceled check. What is a canceled check? Now, Ali and Mu'tasim and Muhammad Nasr and Muhammad Al-Sada and Sharat, give me 100% of your attention. Understand this thing very clearly so that you don't have a trouble after this with the business of a check. Are you there with me? Are you following? Are you there? Muhammad Al-Sada, Muhammad Al-Nasir, Sharat, Ali, are you there? Muhtasem, okay, very good. Now, my children, this is the check that your client has written to the supplier. Your client is the one who's paying, the payer. The one who's paying is your client. Who will sign here in the front of the check? Someone from your client's office. Someone who works for your client, a manager, supervisor, whoever it is that is authorized to sign here will sign. This is called the authorized signature. This is called the authorized signature. It is made by the payer. It is in the front of the check. Clear? In the front. When your client is writing this check, this is the back of the check, it is empty. When your client writes this check and sends it to the supplier, the back is empty. Once the supplier receives, they sign in the back and they put a stamp here that says for deposit only. For deposit only. So that if they send a T-boy with this check to the bank, the T-boy has no option but to deposit this amount in your bank account. So the supplier signs here at the back of the check. This is called endorsement. This is made by the payee in the back of the check. This is made by the payee in the back of the check. Clear? The signature in the back is called endorsement. Now you're saying it is clear. Let me see how clear it is. When your client receives a check, when the client is receiving a check, whose signature is going to be in the front? Think about it. Don't answer very quickly. Think about it. Your client is receiving the payment. Whose signature is going to be in the front? The payer. Very good, Muhammad. Who is the payer? When your client is receiving the payment, who is the payer? Customer. Excellent. Excellent. Outstanding. When your client is receiving the money, the signature in the front is by the payer, which is your client's customer. Who is the payee? Who's the payee? Who is the receiver of this payment? Quick, quick. It's not a trick question. Are you awake? Who is receiving this payment? When the customer has signed in the front, who's receiving the payment? The client. So who is the endorsement from? The endorsement? Client. Very good. Is this clear? Is this clear to you all? Okay. Now, this is a canceled check. What happens? Your client writes this check. It goes to the supplier. The supplier endorses the check and deposits it to the bank account and again gets the payment. Once this whole process completes, this copy, a copy of this check, is given back to your client by the bank so that they can have this for their record. This check is already used. This is called a canceled check. The check is done. They cannot use it anymore. This is there in your client's office. This copy is in your client's office. So you can examine this. This is called a canceled check. The first thing you're doing is you're taking a sample of entries from the cash disbursement journal and you want to see, okay, I have this check number 210, $496. Where is the canceled check? Is there a canceled check? Can I see the canceled check? Okay, you signed. Very good. The supplier endorsed. Excellent. So this is proof of payment. That means it happened. It was recorded and it happened. Is that clear? Okay. So that's the first document. Second, if there is a disbursement to your supplier, there must be a voucher packet. Voucher packet. Let me see if you remember anything from before the spring break. How many documents do we have in the voucher packet? 3. What are they? Purchase order is the first one. Receiving report is the second one. What is the third one? Vendor invoice. Excellent. So this is, right? These are the 3 documents: purchase order, receiving report, and invoice. Again, coming back to this, if I have a payment to this supplier, then I would have a voucher packet. Voucher packet should show 496. Receiving report should show 496. Invoice should show 496. Beautiful. I am satisfied it happened. Clear? The purchase order, receiving report, and invoice. And then I would also find this amount in the bank statement. So if I go back to the bank statement, I'm going to see payments. I'm going to see, and if it was a check, then I would see the check number in here. It says reference, right? Right here, check number 409. I would see that as well. Okay? Is that clear? Excellent. Now, the second management assertion, which is completeness. Now, very simple to understand. This is the opposite. Everything that happened was recorded. So we start from the front. We take a sample of remittance advice. I showed you the remittance advice, and we make sure that every single remittance advice was recorded in the cash receipts journal. And we also can take deposit slips, money that was deposited into the bank account. We can go from the deposit slips and then going forward to the cash receipts journal to make sure that everything that was deposited was recorded as received. Same with the cash disbursement. We take a sample of canceled checks. So now we have canceled checks. We want to make sure that all of those were recorded in the cash disbursement journal. And we can also take the voucher packets and those going forward, right, from the beginning to the end. We want to make sure that everything that happened was recorded. So if you understand the order, right, of the documents, you can go front to back and you can go back to front. In occurrence, you go to the end and you go back and check whether it happened. In completeness, you start from the beginning and you go to the end to see if it was recorded. Are these two things crystal clear to you? Are you there? Right. So if cash disbursement was cash, you will still have the purchase order, the receiving report, and the invoice. You follow? So you can go and you can match those with the recording of the disbursement. Is that clear? Okay. Now, for authorization, you want to make sure that everything that was received was properly authorized before it was deposited. And the way you ensure that is you take a sample of deposit slips and make sure that the signature is present. Now here, if you see in the deposit slip, your client will sign here. You see this? For every deposit slip, there is going to be an authorized signature. That means your client is aware that deposit is being made into the bank account. So you want to make sure that the signature is there in the deposit slip, and then you also want to make sure that there is endorsement for proper authorization in the check. Now, a check, when the check is received, remember, when a check is received from the customer signs at the front of the check, which is the authorized signature. Your client endorses the back of the check, which is the endorsement for depositing. So you want to make sure that it was properly authorized for deposit, which is the endorsement from your client right here. Okay, you want to make sure this is authorization for deposit, and for cash receipts you want to see that this is present, right? For cash disbursements, you want to examine a sample of canceled checks for authorized signature and proper endorsement. right? So if money was paid, right, and businesses, when they pay other businesses, most of the payment is either through checks or through automatic transfer. So let's say Al Rayyan Water Company is getting paid by Lulu. It will never be with cash. It will be either with check or an electronic fund transfer. So you want to see that the canceled checks have proper authorized signatures as well as endorsement. This makes sure that the one who paid authorized it and the one who received authorized it before it was deposited. Is that clear? This is to check the management assertion for authorization. Is that clear? Okay, the last assertions that we're going to talk about is the accuracy. Now remember, this, what we're going to talk about right now, you don't have to do this separately. You can do this when you are testing occurrence and completeness. Accuracy is to make sure that the amounts and the totals and all of those things are accurate. So what we have to do, take a sample of daily deposits. And remember, you already looked at a sample of daily deposits. When you are doing that, you want to make sure that the amounts in the daily deposits and the amounts in the remittance advices and the amounts in the daily deposit slips all match the cash receipts journal and the bank statement. So when you get the money from the customer, either you deposit cash or you get it electronically, you will have proof that amount is recorded in the cash receipts journal and that amount is also shown in the bank statement. So you want to make sure that all of these amounts match. If one of these people who recorded these items made a mistake, then you will be able to catch that when you're doing this. And you go through these documents when you're doing the vouching and the tracing for the completeness and accuracy, for completeness and occurrence. The accuracy you can also test while you're in that process. Is that clear? Accuracy is making sure the amounts are recorded accurately. Is that clear? Now, there is one extra step here. All cash receipts are also recorded in the general ledger, but they are not recorded item by item. So let's say you received payments from 10 different customers in a day. The cash receipts journal will have 10 different entries for each of these amounts individually. But the general ledger will have only one for that daily sales, right? So you want to make sure that the cash receipts journal entries are the same. The amount matches the general ledger journal entry, okay? To make sure that items are recorded accurately. And you do it, of course, you take a sample and you do it. You cannot do it for every day, but you take a sample and you make sure that cash receipts journal entries match the general ledger. Is that clear? This is for cash coming in. For cash going out, same process when you're doing the vouching and the tracing for the completeness and occurrence. Take a sample of voucher packets and you agree the amounts in the purchase order, receiving report, and invoice with the canceled check and the disbursement journal. So all of these numbers that are recorded in these different documents for the same sale should match. There should be for the accurate amount. And if there is multiple items in the same purchase order receiving report, you would go and you would add the amounts and make sure that they are accurately added. The same thing applies for the cash disbursement journal and the general ledger. Cash disbursement journal shows every single small item that was paid. General ledger shows the whole amount. So if you made 3 payments to 3 different suppliers, but it was for the same thing, it was for inventory, the general ledger would have a total amount of inventory purchased during that day. the cash disbursement journal will have itemized items. So if you add the cash disbursement journal and you look at the general ledger, the amount should match. Is that clear? Are you there? Okay. I know this is a lot of information, but this chapter is very important for you to understand well to do the audit simulation. And if you understand it well, you can get full marks in the audit simulation, right? Or very high score. So I encourage you to listen to the video again, watch the video again before the next class, and be ready for additional items. There's a question that says, what will be shown in the general ledger if it's cash receipts? It's revenue, either revenue from service provided or revenue from sales, right? Revenue from, so for example, if you go to Lulu and you make a purchase of 500 rials, and then I go to Lulu and I make a purchase of 200 rials, the cash receipts journal will have two entries, 500 from you, 200 from me. Customer 1, customer 2. Sales number 1, sales number 2. But in the general ledger, all the customers that purchased from Lulu will have one entry as sales for that day. Are you following? Otherwise, the general ledger will be unmanageable. Just think about it. If 1,000 customers coming in, general ledger will have 1,000 lines. It's not necessary. The cash disbursement journal, the cash receipts journal will have those lines, and you can go and check the details. But when it comes to the financial statements, the sale for that day is 10,000 rials. Khalas. That will be in the general ledger. Is that clear? All right. So we'll end here, inshallah. I will see you on Tuesday. Assalamu alaikum wa rahmatullahi wa barakatuh.